For 9.5 months, splitting a payment into 4 was, as far as the Federal Consumer Finance Regulator was concerned, using a credit card. That began on the 30th of July, 2024. It ended on the 12th of May, 2025, when the same agency withdrew its own position. The installment rule was the first item on the list. Almost nobody noticed either date. The most watched video on this subject was published 10 months after the second one. This episode is about what happened in between, and about a distinction that decides whether any of it matters. The difference between an agency changing the law and an agency changing its mind about the law. Those are not the same thing, and almost every account of this gets it wrong in one direction or the other. You are at a checkout. Next to the card fields, there is an option to pay in 4, and the 4 payments are usually 2 weeks apart with no interest. You tap it. There is a short check, often a few seconds. You pay a quarter of the price, walk away with the goods, and 3 more payments come out of your card automatically over the next 6 weeks. That is the whole product. It is a short, small loan made at the moment of purchase, usually with no interest and no stated fee to the buyer. The shop pays for it. The lender takes a cut of the sale, larger than a card network takes, in exchange for the shop selling more. For most of its existence, the reason this sat outside credit card rules was straightforward, and it is worth stating properly rather than as an accusation. A credit card is an open line you carry around. You are approved once, you have a limit, you use it repeatedly, and a statement arrives every month. Pay in 4 looked like the opposite of that. 1 purchase, 1 small loan, 4 payments, over in 6 weeks. It is closer in shape to a layaway plan than to a revolving account, and layaway is not a credit card either. So when the regulator began looking at it, the interesting question was not whether the loans were harmful. It was whether the shape of the product had quietly changed into something else. Here is the thing the regulator fixed on, and once it is pointed out, it is difficult to unsee. To use pay in 4, you do not apply for a loan each time. You have an account with the lender. It exists between purchases, it persists, and the lender knows who you are when you come back. That account tells you what the agency's document calls an amount available to spend, which is a limit, described in different words. And using it again is frictionless. That is the document's own term. No application, no waiting, no decision you have to make consciously. The second loan is easier than the first, and the 20th is easier still. An account with a limit that you use repeatedly without reapplying is not obviously a layaway plan. It is a lot closer to something else. The scale is in the same document, and the growth is the part that made the question urgent. Across 5 leading lenders, the amount lent through these products went from $2 billion in 2019 to over $24 billion in 2021. 12 times in 2 years. And in a survey the agency ran, 17% of consumers with a credit record said they had made at least 1 purchase this way between February of 2021 and February of 2022. Roughly 1 in 6, not a niche. But the figure that changes the argument is not how much was lent. It is how the lending was being used. Over that same period, the average number of these loans taken by one borrower from one lender in a single quarter went from 1.9 to 2.8. And the share of borrowers taking more than 5 in a quarter went from 6.3% to 15.5%. That second number more than doubled. It means the fastest growing part of this was not new customers trying it once. It was existing customers using it more often, from the same lender, several times in the same 3 months. Read those 2 figures together, and the product has stopped behaving like a one-off loan and started behaving like an account somebody is living on. And note the boundary on that measurement, because it makes the real number larger rather than smaller. Those counts are per lender. Somebody using 4 different installment apps appears in the data 4 times as 4 separate light users, and there is no line in the document that adds them up. That is not a criticism of the agency. Each lender can only report what it sees, and no lender sees the others. But it means the picture of how much of this a single household is carrying at once is not in these figures, and nobody who quotes them can honestly say it is. What the document does say about those borrowers is separate and worth keeping separate. Compared with people who do not use these products, they tend to carry more debt, to carry balances on conventional cards, and to have delinquencies on traditional credit. That is a description of who, not a measurement of how much installment credit any one person is carrying. And the two get conflated constantly. The same document describes who, and it is worth reporting exactly as written, rather than summarized into a point. The agency states that certain groups showed a significantly higher likelihood of use: Black, Hispanic, and female consumers. Consumers with an annual household income between $20,000 and $50,000, and consumers under the age of 35. It also states that compared with people who do not use these products, borrowers who do tend to carry more debt, to carry balances on their conventional credit cards, and to have delinquencies on traditional credit products. That is a correlation described by a regulator. It does not say the product caused any of it, and neither will I. What it does say is who is standing in front of the checkout button. In May of 2024, the Consumer Finance Regulator issued something called an interpretive rule. The name matters more than anything else in this episode, so here is the distinction plainly. A regulation is a new legal requirement. To make one, an agency has to publish a proposal, take comments from the public, respond to them, and issue a final text. That process takes years, as the container billing rule in an earlier episode did. An interpretive rule is not that. It is the agency stating how it reads a law that already exists. It does not create a requirement. It announces the agency's understanding of a requirement that was already there, which means it can be issued quickly and, as we are about to see, withdrawn just as quickly. The agency's position was that lenders who issue a digital user account used to access credit meet the criteria for being card issuers under the existing lending disclosure rules, and that such lenders are therefore creditors under a specific subpart of those rules. The subpart covering periodic statements and billing disputes. Notice the reasoning. It does not say pay in 4 should be regulated like a credit card. It says pay in 4 already is, because the definition in the existing law turns on issuing an account used to access credit, and that is what these lenders do. Whether that reading is correct is a legal question this episode is not qualified to settle, and it is precisely the question that came into dispute later. Set the legal argument aside and consider what the billing disputes subpart actually gives a person. If you buy something with a credit card and it never arrives, or arrives broken, or is not what was described, you can dispute the charge with the card issuer. The issuer has to investigate. While it does, you generally do not have to pay the disputed amount. If you win, you get the money back. That is the machinery most people mean when they say a card is safer than a debit transaction. It is not about interest rates. It is about who has to argue with the shop. Applying that subpart to pay in 4 would have meant the installment lender carrying the same obligation. Your third and fourth payments could not simply keep leaving your account while you argued with a merchant who had gone quiet. The rule became applicable on the 30th of July 2024. On the 12th of May 2025, the same agency published a document withdrawing a large number of the guidance materials it had issued since it began operating in 2011. Interpretive rules, policy statements, and advisory opinions, together in one notice, effective immediately. The list of withdrawn interpretive rules is numbered. Item 1 is the installment rule, named in full, with its Federal Register citation, not buried in an annex. First, the document explains itself, and the explanation is worth quoting closely because it is the argument rather than the outcome. The Bureau says that in many instances, its guidance had adopted interpretations inconsistent with the text of the statute and had imposed compliance burdens on regulated parties outside the strictures of notice and comment rulemaking. And it states a general policy going forward: to avoid issuing guidance except where it is necessary and where compliance burdens would be reduced rather than increased. There is a complication in that argument, and it is in the earlier document rather than this one. When the agency issued the installment rule, it wrote that it was collecting public comments on it, even though it was not required to, and it set a deadline about a month after the rule became applicable. It also said it might revise the rule after reviewing what came in. So the criticism that this kind of guidance skips the stage where the public gets to argue is, in this specific instance, only partly true. The argument was invited. It simply happened after the rule was already in force rather than before, which is the part that genuinely differs from making a regulation. I am pointing that out because the general criticism is strong, and this particular example is a weaker illustration of it than it first appears. And both of those things are in the documents. Read that as an argument about method, not about installments. The claim is that an agency should not create obligations by announcing an interpretation, because doing so skips the process where the public and the industry get to argue first. That is a serious position, held by serious people, and this episode is not going to pretend otherwise. Now, the distinction the whole episode rests on, and the one almost every version of this story gets wrong. Withdrawing an interpretive rule does not repeal a law. The lending disclosure statute existed before 2024. The regulation under it existed before 2024. Both exist now, unchanged by either of these documents. What was withdrawn was the agency's stated reading of them. So the honest description of the change is not that protections were removed. It is that the regulator stopped publicly asserting that they applied. It would be easy to treat that as lawyers' hair splitting. It is not, and the difference shows up in exactly the place a person would care about. If the interpretation was correct, then the obligation existed all along, exists now, and would exist if the agency said nothing at all. A lender who ignores it is exposed, and a court could say so. If the interpretation was wrong, then it never applied, and withdrawing it changed nothing except the paperwork. Either way, the law did not move. What moved is the likelihood of the agency itself taking action, and the confidence anybody can have about where they stand. The honest summary is uncomfortable, and it is the truth. The question of whether these protections apply is now unsettled, and it was settled, in one direction, for 9.5 months. Unsettled has a practical meaning worth spelling out, because it is not the same as absent. A lender deciding how to behave now has to weigh a reading the regulator published and then withdrew without saying the reading was wrong on the merits. The withdrawal argues about how obligations should be created, not about whether an account with a limit is an account with a limit. A person disputing a charge is in a similar position from the other side. The argument that the subpart applies is still available to them. What is missing is an agency standing behind it. And the thing that would actually resolve it, a court deciding whether the definition covers these lenders, has not been reported here because I have not verified it. Secondary sources mention litigation. I have read the two documents, and nothing in either tells me how any of that ended. A fair question, and I am going to answer it carefully rather than confidently. The protections that come from the card in your wallet are unaffected. Most installment plans take the payments from a card, and that card's own dispute process is between you and your bank. The rules of the installment lender itself are contractual. They exist, they vary, and they are whatever the terms say. And the general prohibitions on unfair or deceptive practices are statutory. They did not come from the withdrawn document and did not leave with it. What is missing is the specific, named machinery of the billing dispute subpart being asserted by the regulator as applying to these lenders. That is a real thing to be missing. It is also not the same as nothing. Both dates passed with very little public attention, and the reason is structural rather than conspiratorial. The rule arrived as an interpretive rule, which is not the sort of document that generates headlines, because on its face, nothing new was being required. The withdrawal arrived inside a list of dozens of unrelated documents, in a notice about guidance policy in general. From the outside, it looked like housekeeping. And the subject itself is a checkout button, not an institution. There is no building to photograph and no hearing to attend. The measurable result is that the most watched video on this topic went up 10 months after the withdrawal. And the field around it is still largely arguing about whether the product is a good idea, which is a different question from what rights attach to it. Step back from installments, and the shape of this is the interesting part. A product grew 12 times in 2 years and changed character while it grew, from a single purchase loan into an account with a limit that people use several times a quarter. An agency noticed and said, quickly and without new legislation, that the existing rules already covered it. 9.5 months later, a differently led version of the same agency withdrew that, arguing that announcing interpretations is the wrong way to impose obligations. Nothing in that sequence required a vote in Congress or a decision by a court. The rules a person is subject to at a checkout changed twice, in under a year, through documents almost nobody read. Because it is easy to tell this as a story of protection taken away, and that is only one reading. The case against governing by interpretation is genuine. If an agency can create obligations by publishing its opinion of an existing law, then the obligation can appear without anyone affected getting to argue, and it can disappear the same way when the leadership changes, which is exactly what we just watched happen. Notice and comment is slow and frustrating and produces documents nobody reads, and it also produces rules that survive a change of administration. Somebody who wanted stronger protections for installment buyers and who thought about it for a while might reasonably prefer them to arrive as a regulation rather than as a reading. Both documents are public and short by the standards of federal rulemaking. The interpretive rule sets out the reasoning about digital accounts and card issuers in a few pages, and the market figures quoted in this episode are in its background section. The withdrawal notice is mostly a list. If you want to see how a thing like this actually happens, read the numbered list and notice how little the format distinguishes between an obscure disclosure opinion from 2012 and the rule about a product 1 in 6 adults had used. That flattening is not an accident of formatting. It is what withdrawing 60-odd documents at once looks like. Not that installments are dangerous, and not that anybody was wronged. Neither is established by these documents. What is established is narrower and more useful. The consumer protections attached to a payment method are not a property of the payment method. They are a property of how the law is currently read, by an agency whose reading can change without the law changing. Which means the sentence people say that paying one way is safer than paying another has a date attached to it, whether or not anybody says the date out loud. So here is what is actually in front of you at the checkout. A short loan, at no interest to you, paid for by the shop, taken through an account you already have with a limit you were told about in different words. A product that grew 12 times in 2 years, and where the share of people taking more than 5 loans a quarter went from 6% to 15%. For 9.5 months, the federal regulator's published position was that this arrangement carried the dispute rights of a credit card. Since the 12th of May, 2025, it has no published position at all. The law underneath did not change on either date. What changed was whether any one official was willing to say what it meant. And that is worth knowing before you tap the button. Not because the answer is alarming, but because most people believe there is an answer.